What's going on? This is David W. Williams, also known as Diamond Dave. And so what we're going to talk about really quickly is how to view implied volatility like a market maker, right? And so not knowing this about implied volatility can kill your account. This is going to be a really good video for options traders who want to try to understand how implied volatility and how the market makers set and use implied volatility to benefit them, right, can go against you as an options trader. And this is the kind of stuff majority of people don't really understand. And so we're going to talk about a lot of situations that options traders can find themselves in and really don't understand what happens. And as a result, they don't get the returns that they desire, or it starts to erode their account when these particular situations go against them. And it's because at the beginning, at the onset, they didn't really realize how dangerous the situation was, right? So what we're going to do is we're going to kind of break down things in a case-by-case and scenario basis. And once you understand this, you can start applying this to your options trades, and it's going to put you in a position to be profitable as opposed to putting you in a position where you just lose money. So let's go ahead and get into it. So when you get ready to buy an options contract, a lot of times emotionally you hyped up, you enthusiastic, you're euphoric because you really believe you're getting ready to make some money, right? Because you bought the contract from the belief that you're going to be able to turn around in the market and sell this at a profit. And that's your real desire because you're thinking about what are the results that I can get from successfully selling that contract is really what you want. So the options market is essentially a vehicle. So this is your emotion. Now, for a lot of us is when the contract goes against us and things don't go the way we desire, this is how we feel. We're very upset. We're very mad, right? Because the way the setup looked or the way it presented, we thought it was going to be a good situation and then it turned against us. And it's not that the market did something wrong. Many of us really don't understand the environment that we're operating in. So a lot of times we can be doing well and we don't really know why we're doing well. So then therefore, when things go against us, we don't know how to diagnose it and fix it. So let's go ahead and get into it. So here's some of the things that kill options contracts, right? From a volatility standpoint. It's horizontal movement kills the premium as you approach expiration date, right? And the expiration date starts to combine with theta decay. So you're getting horizontal movement that's killing the premium because you're getting closer to the expiration date. So now theta decay is killing the contract. The expected movement does not happen and it kills your premium. And this is really important around binary events. What I mean by binary events like earnings. So earnings is considered a binary event, right? And so what they do is they set an expected movement and that doesn't happen. And then what it does, it starts to erode your premium. You enter with implied volatility too high. However, you don't know that. So many people are buying contracts, and I made this mistake a lot, and I still sometimes make this mistake, where you enter with volatility, implied volatility too high. And because it's too high, right, essentially, even though delta may look good, the whole situation is very much stacked against you. So yes, we're playing the game of probability, but it's very unlikely things are going to go the way you desire because volatility really is too high. We're going to talk about that a little bit more in depth. And you don't understand it. You never understood how to view implied volatility like a market maker. So you have to understand how was a person that's making the contract and creating the volatility predictions, how are they thinking? Because they're not your friend. They're not creating contracts because they're trying to do something good for you. They're trying to create a market in which they profit. That's their job. They don't create these markets so they can lose money. They create a market so they can profit. Same thing if you go to Vegas. If you go to Vegas, the job of Vegas is for them to make money. It's not for the gambler to make money. They want the gambler to enjoy themselves enough where they come back. But the goal of Vegas is for the casinos to make money. That's why Vegas has sustainability. So let's go ahead and break these down point by point. So horizontal movement kills the premium as you approach the expiration date. So here's an example of Kodak, right? And so I bought put contracts on Kodak after we had that really crazy upswing in their share price up from $2. And what happened was I anticipated the fall off of the share price to be faster than what actually took place. So if you're looking at the dates, 8/10, and we're starting to see a decline, right? But it's not a rapid decline. It's a really slow, gradual decline. So from 8/10 to 8/12, look at the decline. I'm sorry, from 8/10 to 8/11, look at the decline. Then from 8/11 to 8/12, look at the decline. Then from 8/12 to 8/13, look at the decline. It's very gradual. From 8/13 to 8/14, look at the decline, right? Then from 814 to 817, look at the decline. Then you see on 818, it popped back up, went back down, and on 819, you're starting to see a very gradual decline right now. And so what you see is that because it's pretty much trading horizontal, it's killing the premium. Because what you want in this scenario, right, you want a really rapid decline. So I was under the impression when I bought these contracts, I think the share price was around $30. I thought it was going to be at around $7 to $8 within 7 days. So I bought contracts on Thursday and Friday, and I figured by that next week, it'll be around $7 to $8. And based on the volatility forecast when I bought it, because of the volatility was at a certain percentage, I needed a really, really rapid decline in the contract to really make the premiums go up real high. Once this thing started essentially day trading, it put me in a position to where I was able to get profit on the contracts, but not what I anticipated, because I assumed that this would go down as fast as it went up, and it didn't. The decline in Kodak was very, very, very slow. And we're seeing even now, it closed at, I think we're at 9/12/2020, and it's 640. So we're seeing a very, very, almost not 100% horizontal, right? But a very a gradual decline. And that doesn't help you as an options trader. We want volatility in the direction that we desire, right? What doesn't help us is gradual stuff, right? We want volatility in the direction that we desire. So we believe it's going to go up. We want volatility going up. That's what really boosts the premium on our contracts. If we believe it's going to be a decline, we want volatility going down. So this was a bad situation. So even though I profited it, I didn't get as much as I thought I could have gotten because I wasn't able to get that rapid decline. So the fact that the volatility was high, I paid a lot of money to get in the door, right? And I didn't make as much as I desired on the way out. Let's get into the next example. Expected movement does not happen and it kills your premium. So we're going to talk about that, but also binary events, what we call earnings, right? So we look at Peloton, right? So Peloton, I believe, reported on the close on 9/10. So if we look at Peloton from 9/8, what do we see? It goes up 9/9. It increases a little bit, right? So from 9/9 to 9/10, you saw a gradual increase, right? Then from 9/10 to 9/11, right before they reported, we saw a decline. They reported overnight they reported in the evening or aftermarket 9/10, and it gapped up in the open. And then what did it do? Started to decline. So if you had options that expired at the end of the week or the week after, right, at $90, at $92 or $95, if you didn't sell immediately at the open, your contracts immediately start to lose value, because this is what happens. What the market makers do. When you have an earnings date, what they do usually the day before earnings is they set an expected move, right? And what they mean is that after reports, they expect the price point to move in a certain direction. Then what a lot of times they'll do is they will adjust volatility forecast based on that expected move. So then when the stock opens up the next day after earnings, if you don't start to see that move, right, the closer your contracts are to expiration, the more they start to lose premium, right? So if your contracts go out for Peloton maybe 3 to 4 weeks, the premium decline may not be that great. But if your contracts are expiring at the end of that week, you started seeing a massive loss in premium, because what happened? You didn't get the expected move, which therefore you didn't hit the volatility forecast, because volatility forecast is based on the movement, right? And that's how they determine the price of the particular security. You didn't get that movement. So what happens now is you start losing premium. So this is why a lot of people advise don't ever hold after earnings, because once they set that adjusted move and they report after earnings and you don't get the movement, right? The contracts that have the closest date to expiration are going to start to lose a massive amount of value really, really fast. And you may not get time to recover based on where that contract expires. So if they report on Thursday and then you come out Friday morning and you don't get the movement and your contract expires on Friday, what's a wrap? Right? It's a wrap. So a lot of people, what they recommend is that you should always play the upside. So like you see that on 9:10, it opened, and I want to say maybe around, let's say 9:30, 10 o'clock, it was around 95.50, right? That would have been a good time to exit if on 9/8 you would have bought a, let's say, an 85 or 80 or $90 contract to expire at the end of the week. So you maybe bought a weekly, right? That would have been a good time to exit. If you didn't exit at that time, what did you see? 9:10, it started to fall, started to sell off. Then it gapped up. But if you see that on 9/11, where it gapped up at, right, was lower than the highest point the day before. So you didn't even get the gap up to match where you at the highest point the day before. So this is what I'm saying. When the expected movement does not happen, it kills your premium because the expected movement correlates with the volatility forecast. So when that doesn't happen, it's going to kill your premium, especially on shorter term contracts, right? So let's get into the next example. You enter with implied volatility too high, however, you don't know it. So one of the things, I know a guy that makes a lot of money in the options market. He recommends that when you're looking at calls and puts, you always look for volatility around 50%. And he says, look for 50% and 60 to 90 days out on the contract. In his mind, if I can't get 50% and 60 to 90 days out, I don't want the contract. He doesn't do weeklies at all because his attitude is they're too risky, right? He says you can make money on it, but he says over the course of time, you're going to lose more money than what you make. So looking at these contracts right here, you're seeing that these Apple calls for October 23rd, right, in the money and out of the money, they're around 50%, except the 90 and the 95 are in the 60s, right? And it's really unusual is that the 105 is 48%, but the 110 is 52, but the 100 is 54. That's really weird how they set that. But you got to understand is that looking at these Apple calls, right, they're all around 50%. Now, if these Apple calls were around, let's say 80 or 90%, so let's say the 116, right, strike for October 23rd was around 80%. And I buy that 116, but it's 112, right? So I buy on Monday, which is going to be what, the 13th, I believe, right? I buy the 116 Apple contract, it's a call contract to expire on October 23rd. We're at 112, right? I'm going to need a lot of momentum between now and October 23rd to increase the premium on that contract, right? Because of the volatility, the move of it is already baked into the contract. So listen to what I'm telling you, because this is a term that a lot of people use in the market and it's overused. The move, if the volatility is 80 or 90%, that movement is already expected. So because it's already expected, right, my break even, right, may be past my strike price. That's why I always recommend, always try to exit $1 or $2 in the money, right? Always look to exit, always buy a contract and you're looking to exit $1 or $2 in the money if you're trying to get profit. Because of the volatility forecast, and you can a lot of times based on your brokerage account, you can see what the break even is for each particular contract. But a lot of times just based on the volatility forecast, right, your break even can be past your strike price because of volatility. So this is what people got to understand. If you buy that contract and it's a higher volatility, you got to start seeing a lot of momentum in that amount of time to increase that contract. To where if you had a 115 or 116 that expired October 23rd, 2021, because we would assume that Apple's going to be way over 116 by October 23rd, 2021, right? You don't have to worry about that momentum movement because what? You got so much expiration on the contract. That's why a lot of people recommend 60 to 90 days because it gives you more time. So you're going to pay more for premium, but you got more time to get the move. Well, a lot of people like to buy weeklies because they're less expensive, but you got to get a lot of rapid movement with a weekly. With a weekly, you got to get a lot of momentum behind the plate, right? Which is why a lot of people recommend don't buy weeklies. But, you do what you want to do because it's your account. You're an adult. You can make decisions for yourself. Let's go ahead and get into the next one. So, one, you never understood how to view implied volatility like a market maker. So this will be going back to the market makers. Understand, the market makers are not your friend, right? They create markets so they can make money. Right? you have to learn how to make money in their market. The way you learn how to make money in their market is you have to understand how they think. Their job is to leave you holding the bag. That's their job. That's how they make money. You got to understand capitalism, right? Their job is to create something that you're going to buy, and they're going to leave you holding the bag, right? Your job is to let somebody else hold the bag or give somebody else a contract that they can exercise at a strike price that they desire. So it's not always a negative thing, because you could be selling a contract to somebody at a strike price in which they want to exercise the contract. Or you could be selling a contract to somebody that thinks that contract is going to continue to appreciate and they get left holding the bag, right? But that's not your concern, because they bought what they wanted to buy at that time. Just like I live in the state of Florida, there is no limit law here. It don't mean that you look to sell somebody a bad car. What it does mean is that if somebody buys a car from you and 2 weeks later it go bad, they can't come back to you about anything. Why? Because there's no limit law. So you got to understand the game that you're playing, right? So a lot of people in the state of Florida that are looking to sell you used cars, they're not your friend if you don't know them personally. So you got to make sure you do things like get the car inspected, things of that nature. And I would never buy a car in the state of Florida if the person would not let me go get the car inspected before I buy it, because I know there's not a limit law. So if I buy it and I get around the corner and it breaks down, once we execute the sale, I can't do anything about it. I can't take them to court because there's no limit law in the state of Florida. So you always got to understand the market that you're operating in, right? What you understand about options. When the implied volatility is high, and so we're using 50 as a baseline, but it doesn't mean that's a baseline for you. It means that we're just using this for an example. So we're calling 50 a volatility baseline, right? So we want our volatility to be around 50 or less if possible, right? If implied volatility is high, right, which I mean greater than 50, right, the seller makes money. Now, I want you to understand what that really means. You're buying the contract from a market maker. The implied volatility is, let's say 45 or 30, right? So you're able to buy it and enter the door at a lower premium, right? Market conditions change. There's a lot of momentum put behind that particular share price. It goes up. So you bought a call contract, right, with an implied volatility, okay, less than 50. So let's say 35, 40. That's what you bought it. Now I know that's going opposite against the greater or less than, but I want you to understand what I'm telling you. You bought a contract from the market maker. Implied volatility is, let's say, 40. It's a call contract. You pay less to get in the door. And I'm using that term, get in the door. What I mean is that you're able to enter this situation at that price point, right? Momentum is put behind that share price. It goes up. The market maker resets volatility on that strike price. Volatility now goes up to 80%. So what do we know now? The volatility, right, is a forecast of the movement of the security, which is also used to set the price of that particular security. So now they reset the premiums. Premiums go higher. You now own the contract. You're the seller. So now you can go sell it for more money. On the flip side, when implied volatility is low, less than 50, we're going to use 50 as a baseline, right? The buyer always takes advantage. So that was an early example. You're looking at a contract, right? And you want to buy it and the implied volatility is 30. You're the buyer now. You're able to buy that at a lower premium. However, you don't get the share price movement that you desire. You're getting closer to expiration and you got a low volatility. So now what happens? Right? You're able to take advantage, but the person that wants to buy the contract from you now, right? The buyer, because you got to sell it. So now once you buy the contract, you're not a seller. Who now takes advantage? The next buyer. I hope I didn't confuse that. So I want you to understand, when volatility is high, the seller makes money. But as soon as you buy the contract from the market maker, you're not a seller. So what do you need now to make money? High volatility, because you now own the contract. When implied volatility is low, right, the buyer takes advantage. So as soon as you now buy a contract from the market maker, implied volatility is low. What does that mean? The next buyer takes advantage. Now you got to understand, this is all predicated on share price movement. So volatility is high in a binary event and you don't get the movement. What happens? You start to lose premium. You understand what I'm trying to tell you? So you got to understand what is going on in the market and how these market conditions are going to affect your volatility. But the most important thing is you got to understand what situation are you entering. So let me give you a real quick example before we wrap this up. when coronavirus is getting ready to really hit America, I bought put contracts on Carnival Cruise Lines because Carnival Cruise Lines had not yet become the face of coronavirus infections. I knew that was going to happen in that area. So what I did was I went in and I bought a put contract on Carnival Cruise Lines. I want to say I bought it in March. I bought essentially maybe $3 or $4 a put, $3 or $4 out of the money. I paid a less than $200 for it. And I bought an expiration date that probably went out 4 months. Why was I able to do that? Because of volatility. They had not yet readjusted the volatility for that situation with Carnival Cruise Lines. During that week, the whole situation with Carnival Cruise Lines and the people on the ship out there in California testing positive, all that unfolded. So what did the market makers do? They went in there and reset all the volatility forecast. I sold that contract for like $600. So I got almost a 500% return on that contract. I went back in to buy at that same strike price, right? So now that strike price was already in the money, but I wanted to buy that same strike price. And when I looked at that contract was too expensive for me at an expiration date going out to like July. So I end up buying that same strike price at an expiration date going out maybe 30 days, and I end up paying $300 for it. So I paid almost 250% more for a same strike price, but a shorter expiration date. Why? Because volatility had already spiked up, right? So what happened? Volatility went up. The seller made money. When volatility was low, the buyer, who was me, I took advantage. And then as volatility spiked up because the situation changed, what did I do? The seller made money. This is why I try to get you to understand. If you can forecast really well in the market, you have the ability or the opportunity to buy when volatility is low, right? Take advantage and then sell when volatility is high. That's why I say you got to really learn what's going on in the market. You can't play follow the leader, because when everybody runs over there, now the volatility is high. So what the market makers want to do is create a scenario where everybody moves in the same direction at the same time. Why? Because then they can spike volatility and people will pay money just to get in without understanding what? When volatility is high, the seller makes money, right? Then if you don't get the movement that you desire, what happens? We're going to go back to point one. What happens when you don't get the movement you desire? Expected movement doesn't happen, kills your premium. It happens on binary events, but it also happens on non-binary events, which we call expiration dates, right? Or horizontal movement kills the premium as you approach expiration date. So what do the market makers do? They create a scenario, right, in which everybody runs in. So what do they do now? They ramp up volatility, right? Then what happens? They pin the share price. When I say pin it, what I mean is that they use algorithms to make the share price trade within a really narrow channel. Then what happens is with your weekly, if you don't get out on Monday or Tuesday, they pin the stock price and you start to see a decay in your premiums because of theta decay. So you went in because of high volatility. You paid a lot of money to get in the door. What you expected was to get the movement that you desire without understanding that even if you get that movement, because you pay so much money in the door to come in the door, your profit is going to be a lot less. So let me give an example of what I mean. We say, hey, you can get into this situation now and pay me $100 and you can sell it for $500. So which means you make $400, right? Well, over the course of the week, everybody hears about that deal. So what I do, because I got so much demand for that deal, is I start to raise the price from $100 to $200. So now at the end of the week, you can get in the door for $200, but still sell it for, I think I said $400 originally. So now you make $200 as opposed to what you would have made if you would have sold it for $100. So what the market makers do is that they try to create a frenzy around a situation, knowing they can get everybody to come over there and buy contracts. But what happens is, because the volatility is so high, even if you get the movement that you desire, what you're going to be able to sell it for is going to be a lot less. Why? Because the only time the seller makes the most money when volatility is high, but you got to find somebody else to sell it to. If the volatility is too high and the premiums are too high, it diminishes the market for something, which is like why a lot of people don't buy in the money. When the volatility is low, the buyer has the ability to take the advantage. So you as an options trader want to try to figure out, how can I take advantage of situations that are likely to happen from a probability standpoint, but I'm not paying so much more money to get in the door. And that's why we talked about look for contracts if you can with volatilities around 50%, and you got 60 to 90 days to get out. But most people don't do that. And I'm not mad at you because I buy weeklies and I buy contracts in which the volatility is not 50%. I do this all the time. But at the same time, if you can become very disciplined as a options trader and only take the trades that have the highest probability for you to be successful, you'll be trading less but making more. But that's the challenge, the discipline, because you see all these opportunities in front of you, but what you start to realize over time is they're not all ideal. So we want to start as traders asking ourselves, what is the most ideal situation for us to be profitable? What's the ideal situation? So people that understand strategy at a deep level, they understand, put myself in the best position to be successful, right? And if I'm not, then just don't get involved in something. You understand what I'm trying to tell you? So that's the real work as an options trader, as opposed to trying to be in a lot of plays because we know we can make some money. What is the best scenario for us to be profitable based on the probability that we're looking for? And we understand that if we can enter in situations that are likely to happen based on our analysis and pay a low amount to get in the door, as everybody starts to run over there, right? It's going to start to ramp up volatility, which means now we can sell for a higher amount because we now have high volatility. So we're almost in the same position as the market maker, right? And so one of the things I want to recommend to you before we close out, if you want to start learning more about how market makers see volatility and how it really works, if you can get Thinkorswim and you can get their paper trade account, you can get Thinkorswim, get their paper trade account, and you can start to paper trade selling options. And once you start to see how by paper trading selling options, and I may create a totally separate video on this. Once you see that, you can start to understand how market makers set options prices based on what they think they can get out of the public for these prices. And then you may have a better scenario and a better understanding of what it looks like from the buyer side. Because a lot of times in situations, people got to see both sides of the situation to understand where they're at. So a lot of times they say if you want to understand the argument, you got to look at both sides of the argument, not just the side that you're on. And so I think for a lot of us, if we start looking at the option seller and how they see the options chain and how they see volatility and how they see delta and how they view premiums because they want to sell them to somebody, right? And what they're really looking to have you do is to either have you exercise the contract or just get stuck with the contract expiring worthless because that's how they make their money, right? And you really understand that's what's motivating them, then you can be a lot more informed of what kind of contracts you want to buy. So I hope this video was really, really valuable to you because I wanted to try to approach this from a direction that most people are talking about volatility. They're talking about it from a very technical standpoint. They're not talking about it from a practical and applied standpoint. So what I want to do is try to give you some context. So when you go into the market, you're looking for setups that are really beneficial to you. And I know that we want to make money. I know that we have desires that we want to use the options market as a vehicle to obtain. But if we can really be patient and wait for a situation that's going to be really, really beneficial to us, as opposed to just getting in everything because it looks hot, I think long term, it's going to allow us to have the success that we really desire because the market's not going anywhere. This skill set is not going to be perishable over time. And the more you get involved in the market and the more experiences you have, the better you're going to get at it over time. If you got any questions, hit me up. If you want to learn more about the highest paid part-time job in the world options trading program, click the link in the description. This is David W. Williams, also known as Diamond Dave. I'll talk to you later.